Hi there, welcome to Kneppy Invests. Aha moments. These are those times when a light bulb switches on in our minds and we discover something new or we fully understand a concept. And one of these aha moments happened to me today, but my favorite personal aha moment happened when I was 6 years old in year one, when I fully understood multiplication. And I distinctly remember this day like it was yesterday because of that light bulb flashing my mind. And I still remember the problem that I had to solve when it just clicked. It was 4 times 3. Now, before this moment, I had no idea how to do 4 times 3. And then all of a sudden, I just went, oh, it makes sense now. 4 times 3 is 12 because you're multiplying 3 by 4. So it's really interesting when you fully understand something, you grasp the idea, and that just becomes, it seems simpler. And today I had a very similar aha moment when it comes to investing. And this idea or this aha moment has been percolating, maybe even festering for many years, but it has become clearer today. I had that aha moment. And is leading to the point where I am evolving my investing strategy to something that suits me. Now, we are told there is only one way to invest. I hear this all the time in podcasts, I listen to YouTube videos, and the only way you invest is for the long term. The belief that there is only one way to invest comes back to how Benjamin Graham, Warren Buffett, Charlie Munger invest. In fact, I do think that there is a bit of a cult following in regards to people who just worship the ground that Benjamin Graham, Warren Buffett, and Charlie Munger walk on. So they believe, because that's how they invest, that is their only way to invest. But there are many ways to invest. And this whole thing about researching a company, buying a company for the long term, comes back to this saying, which is attributed to Benjamin Graham, but there is some thought that Warren Buffett had a bit of weight to this saying as well. In the short run, the stock market is a voting machine, but in the long run, it is a weighing machine. And the question is, what does this mean to you? What did this mean to me? And I'll talk about that in the next slide. And what that saying actually means is that in the short term, the share price of a company is determined by the sentiment. But in the long term, the fundamentals of a company are what drives the share price over a 5 to 10 year period. And I was listening to a podcast, the AusBiz, The Core, and yesterday's episode featured Mark Morland, who is with Team Invest, and Carl Capolingua, who's with Think Markets. And as I was listening to that, I did have a bit of a ha-ha moment. So sort of a smaller ha-ha moment that actually led to a bigger ha-ha moment. And I was just listening to Carl speak and talk about momentum and talk about how a company share price keeps going up, even though it's overvalued, but it's still a hold because you don't know how long that momentum can keep going. On the flip side, Mark Morland and Team Invest is all about fundamentals. They're all about the long term. So in this particular episode of the core AusBiz, there were actually 2 different sorts of investing strategies. We had the fundamental strategy by Mark Morland, and then Carl, and I'm not going to pronounce his last name because I'll probably get it wrong, is all about fundamentals and momentum, or what I like to call it, sentiment. That the core podcast did lay the foundations of the real ha-ha moment I did have towards the end of my run, because I turned off the podcast and I decided to go into deep thought. And that's one of the great things about going for a run, because if you don't listen to music or podcasts, you can go into deep thought. And I had a lot of thinking about the differences between fundamental or long-term investing versus sentiment or momentum-driven investing. And I came to this sort of conclusion. If you break down that 5-year period and remember that initial quote mentioned he doesn't care about what the share price does in 1 year, he only cares about what share price does in 3 to 5 years. But if we break down that 5-year period into 1-year increments, that's when sentiment actually plays a massive role, because sentiment drives the share price higher or lower in each period. But if you turn your attention to that fundamental long-term investor, trying to figure out the profits or the operating cash flow 5 years in advance is actually quite uncertain. There's a lot of risk. And that's why they say, a lot of these sort of long-term investors say, what you want to achieve is a 60% success rate. And if you actually do that, you will become a successful investor. But you might also say, well, 60% is barely a passing grade. And that's where ride your winners saying becomes highly important. But there are some investors out there who just simply can't ride their winners. They will take profits. And that's when this sort of investing strategy becomes an absolutely horrible strategy for them. And again, not all investing strategies works for everyone. We have to find our own light, find that sort of investing strategy that works for us. And so it all comes down to this. The share price of a company from the start of year 1 to the end of year 5 is ultimately determined by fundamentals. So that long-term investor is actually right. But this is sort of my aha moment. But it also can be looked at as the aggregation of short-term sentiment. And what does that mean as an investing strategy? Well, let me show you right now. So another way to look at a 5-year period is just an aggregation of all these different short-term or maybe even medium-term sentiment periods. Sentiment can be high, maybe even neutral or low. But what if you only hold a company's shares when the sentiment is high? So you eliminate those periods of time when sentiment is low. Well, what that actually means is this. In the sentiment momentum strategy, you actually decrease your uncertainty and you decrease your risk because you're not holding a company's shares when the share price is falling or where there's negative sentiment. You're only holding a company's shares when the sentiment is high or the share price is rising. And on the flip side, for that long-term investor or the fundamental investor, you actually have increased uncertainty and increased risk because you're actually holding those company shares when they're falling. And in fact, those company shares or that share price could fall off a cliff like Amazon did during the tech bubble crash. It fell from $113 to $5. But if you listen to some professionals who tell you the only way to invest is for the long term, you would have been holding, or they would tell you, you should hold Amazon when it crashes from $113 to $5 because in the long run, the share price will be higher. But what if you eliminate that period of time when the share price is crashing and then you buy back in when the sentiment shifts from negative to positive? So I just really wanted to test this sort of difference between the different strategies, the strategy that we are all being told is the only way to invest compared to the sentiment momentum strategy. So I went back to the example of Amazon, and a lot of professionals talk about Amazon, how successful Amazon has been, particularly back in 1999, 2000, when the share price fell from $113 to $5. So I just wanted to test the sentiment momentum strategy and see how much more successful it could be by just buying Amazon shares back in 1997 when it listed and just maintaining the holding through the last 25 years. Let's go back to September 1997. I don't know if you remember what you were doing back then. Maybe some viewers of this video channel were not even live back then, which is quite depressing for me. I know exactly what I was doing during that period, and I was definitely not buying Amazon shares at $2.50. So let's just imagine that we had two people and one person bought 4,000 shares on the 5th of September 1997 at $2.50 and decided to use a sentiment strategy. And another investor bought 4,000 shares at $2.50 on the same date and decided just to keep those shares forever or for the next 25 years. So what results would you have achieved with those two different strategies? Well, let's have a look now. At the end of trading on the 4th of January 2021, the current share price of Amazon is a nice round $3,350. So you can just imagine how well both of the strategies have performed. So let's start with that fundamental long-term investor who bought 4,000 shares on the 5th of September 1997, and he hasn't sold a single share or bought another single share. His value of his Amazon shares is now at $13.4 million. That is a nice return over a 25-year period. Please, if you have a time machine, send it my way. So I'm going back to 5th of September 1997 and buy 40,000 shares of Amazon. But how does that compare to the sentiment strategy where you're only holding Amazon shares when there is positive sentiment and you're not holding when there's negative sentiment? Well, in this strategy, you actually are holding on the 4th of January 2021, 17,196 shares, or the value of those shares is $57.6 million. Now, in this hypothetical scenario, there are some assumptions I have used. The first assumption is no taxes. More than likely, in the sentiment strategy, you will be paying taxes because you are buying and selling a little bit more than the long-term strategy. So even if you halve the value of this portfolio because of taxes, you still are significantly outperforming the long-term strategy. Another one is whenever you sell Amazon shares and then you buy Amazon shares, you're investing that amount of shares or the value of the shares that you originally sold out. So you're not putting that money to work in other areas, which is another thing. There are periods of time when you're not holding any Amazon shares, in fact, long periods of time. And the assumption is during those periods of time, you're not putting your money to work. And that is a flawed assumption because I think the longest period you're not holding Amazon shares is for about a 2-year period. So you're assuming you're getting 0% return by not investing in other companies, and that's sort of an opportunity cost. And more than likely, you are investing in other companies and you are having or making a return in those other companies. Now, onto some interesting facts about the sentiment strategy that I used for Amazon. There were 11 trades, and that's combining buy and sell. So overall, 22 trades, but 11 times I did a buy and then a sell. So there is a bit of brokerage as well, which I totally ignored. I last bought Amazon shares 19th of March 2019, almost 3 years ago. In fact, during the COVID-19 financial panic, there was no shift in sentiment. Share price did dip back a little bit, but the uptrend remained intact. So we would not have sold Amazon shares during that period. The other thing I should mention is over the past 6 to 9 months, roughly, share price of Amazon is going sideways. So we can say the sentiment in Amazon right now is neutral, which does raise an interesting question. Should we be investing in a company where sentiment is neutral, where the share price is going sideways, where the share price is consolidating? Because we could be using that money investing in companies where the share price is going up. There were only 6 successful trades out of the 11. So there were 5 times where the trade was unsuccessful. And in those unsuccessful trades, I should mention, a successful trade is when I bought at a lower price than the previous sale, which means the 5 unsuccessful trades is when I bought at a higher price than the previous sale, or I sold at a lower price than the previous buy. That's about a 60% success rate, or equivalent to those long-term investors who say they have a 60% success rate. So again, the success rates are fairly similar in both sort of strategies. The longest time I was holding was 3 years, which is the current holding, but that includes this long period of time the share price is going sideways or there's neutral sentiment. The longest time I was not holding, there were 2 periods where I wouldn't have been holding for over 2 years. There was a 27-month period between 2004 and 2006. There was another period during the dot-com burst when I would not be holding. And during those periods, more than likely, you would be deploying your capital to other companies, to companies whose share price is going up. So again, even though the overall returns using this strategy for Amazon were significantly higher than just buying and holding, they could be skewed because I'm not taking into account taxes, and it could be skewed because of that opportunity cost. where you're not deploying your money into better ideas at that particular point in time or that period in time. That is all I have for this video of why I am involving my investing strategy. I think this is very important as an investor to always test your strategies, to always possibly improve how you invest. And the most important thing is there are many ways to invest. So whenever you hear someone say there is only one way to invest, that is for the long term, just say no. There is many ways to invest because you have to find the way of investing that suits you, that maybe you find more enjoyable. So if you do have any questions about why I am involving my investing strategies, leave your comments, your thoughts, your questions in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a great day. Talk to you later. Bye.